Did you know that there's a way how you can make money when stock prices go down? Yes, it is actually possible to do so, and that's what we call short selling. Now, this is not about selling your shorts that you wear or buying stocks and shortly selling them afterwards. And in this video, I want to explain you what it actually means, how it works, why you might want to consider doing it, and of course the risk, because it has actually quite a bit of risk involved in doing so, and ultimately show you, if you wanted to try short selling for yourself, where you can possibly do so. And you might have come across the principle of short selling before, the famous movie The Big Short, which was obviously before the financial crisis, where people basically betting against housing prices going up. They were predicting a bubble and a collapse and made a lot of money in the process. So a lot of people got excited about short selling, and you can do this with many different things, but most commonly I would say for everyday people and investors like you and I, it's referring to stocks. You can of course also short sell in a way cryptocurrency, but I suppose most people do that for stocks, and that's what I want to focus on in this video. And the first question is, why would you even consider short selling, right? Because most people who invest, they invest for the long term, and they do so by investing in shares and companies or ETFs, buy them at a lower price and wait for them to go up to a higher price and then sell it at a profit, right? So let's take, for example, the case of Nvidia. I mean, over the last year, we are up almost 200%, absolutely amazing. But stocks do go up and down like anything. Nothing ever only goes up. And you see, even across the increase over time, we had periods where it dropped massively, and there have been some pullbacks for sure. And especially when a company grows so fast in such a short period, a lot of people think maybe it's overvalued, maybe it's too hot, and we start seeing a repricing in that share price with prices coming down. And that's exactly where short sellers make the money. They bet on those prices to drop, and when it does drop, they will cash in and make the money. So I have this little graphic over here to kind of visually explain you what I mean by short selling. And I really try to keep it as simple as possible for you to understand the concept. So basically, instead of buying a share that you would normally do and then sell it at the later stage, here you would not buy first, but you would borrow the shares, right? You would borrow, let's say in this example, 100 shares at $100 each, which equates to $10,000. You borrow that. You don't sell it, you don't buy it, you just borrow it from, in this case, a stockbroker, right? Usually use a stockbroker for that, and I'll show you later on how that works. So then the second step is you literally immediately sell it, right? You first borrow it from the broker, and then you sell it at the current market price. Again, obviously, you're going to get $10,000 for it, right? Because that's exactly what you borrowed it for. You literally a second later, you sell it and have that money. However, you still obviously owe the broker the $10,000, right, that you borrowed. So then what you wait is, as a short seller, obviously you anticipate for the price to go down. So in this case, let's say you wait a week, 2 weeks, 3 weeks, whatever it will take. Hopefully, in your case, if you were to short it, you want to sell at $80. So it drops by 20%, it goes down to $80. And when it does go down, that's when you actually buy back the shares. So basically then you go back to your broker and return the 100 shares, right? The 100 shares that you borrowed, you're giving them back, you're buying them back. But this time, obviously they're not worth any more $100, but only $80. So you pay them back $8,000 because you don't pay back the actual money amount. It's not a bank where you take a loan for $10,000. You just give back the shares that you initially borrowed. So the shares that you borrow, you give them back the shares, but now at a much lower price, obviously, to buy those shares back. So you pay for that, you only pay $8,000, but previously when you sold them, you made $10,000, right? So basically that trade alone profited you $2,000. So that's basically the principle of short selling. Now, I don't know about you, but for me, it really took me quite a while to still get my head around it because it's just so unusual concept. You're not really doing that much and you're not familiar with it. So let's make it a bit more simple and give you a real life example, right? Imagine your friend has a beautiful new TV, 4K, the latest model, what have you. Now, he goes on holiday for 2 months and you don't have a TV. So you ask him, mate, can I borrow your TV for the time? And he says, yeah, sure, no worries, right? It's not going to, get less in value just because you use it and watch some movies on it. So he goes out, you take the TV, and immediately next day, you basically put it up on the market, resell the TV, and you make $2,000 in profit, right? You take his TV that is not yours and you just sell it and you earn $2,000. Now time is passing, 2 months have passed, your friend is about to come back and you realize, oof, I owe my friend obviously a TV because his apartment is empty. The TV that you borrowed, you sold, right, at a profit. So now what you do, you hopefully found a way to source the same TV model in another shop, and maybe there's a Black Friday promotion or some deal going on where you find literally the same TV at a lower price point. And usually technology actually depreciates quite fast, right? So it lowers in price. So you go back to another store and now you only pay $1,500 for it. You basically buy it from the profit that you previously made, the $2,000. You pay for it $1,500. You get the TV, you install it just before he comes back. He never knew there's a difference. and you made a $500 profit. So obviously it's a very simplified version of it, but hopefully you get the point. And while I personally don't short any stocks, never have and never will, and I'll come to this when we talk about the risks in a second, it seems quite a few people do that often. And it's really interesting on a website like Seeking Alpha, which is my preferred stock research tool of choice. You can actually find under any company, for example, Tesla, you can go over here and see the short interest. So that's basically the percentage of people betting against the company and basically betting on falling prices. So in this case, 2.38% is not super high, but definitely already quite high. It shows that definitely Tesla, many people believe, is overpriced and they do expect a pull down in prices, right? They basically make money when the stock price falls. But on the contrary, they will also lose money if it continues to rise. So that's something to keep in mind when we speak about the risk. Now let's take a company such as MicroStrategy, right? Really interesting company that really goes heavily after Bitcoin. Look at that, 12.9%. That's huge short interest. So many people as a percentage, that's actually one of the highest short interest percentages I've seen, betting against the company and betting on falling prices. So yeah, if you were a long-term investor, that's certainly something to keep in mind, because often people who are shorting stocks, they can be quite powerful institutions or companies that can even manufacture sometimes some bad press, right? Or bad news or bad articles that comes out. People panic. They say, oh my God, this happened. Then people panic, retail is selling. And then obviously that leads to a drop in price. And even as a short term, they might capitalize on that and make the money and then just get out of their positions. But let's talk about the risk that you face when you short sell, because actually it's really, really risky and I would not recommend any of you to do it. I think it's important to understand the principle and concept of it. But generally, I think the odds are against you, right? While you can make money, and a lot of YouTubers and financial influencers, they always talk about short selling because it's so unusual and they show people how they make money with falling prices and sounds cool. But trust me, it's extremely risky because a couple of things to consider. The first one, obviously, when we look at regular stock purchases, right, over long term, you spend $1,000. If it goes up in price, you make more money, right? If it goes to $1,500, you make a $500 profit. If it goes to $3,000, you make a $2,000 profit. So that's great. The worst case that can happen if you buy a regular stock or ETF or cryptocurrency for the long term, the worst case, if you don't use any leverage, well, it goes to zero. So your $1,000 go to zero. It's going to be painful. It's not what you're investing your money for. But if it happens, it happens. Probably you can just start all over again or learn from the lesson, what have you, right? That's the worst thing that can happen. Now with short selling, obviously you make money when the stock drops in price. However, you're just hoping for it to drop, right? What if it doesn't drop and it keeps on going up and it never hits your selling target, at which price you would sell it, obviously? That means that theoretically your loss can be infinite. So if we come back to the first example where you borrowed 100 shares at $100, now theoretically, as I said, it moves to $1,000 per share. Now at close, you would have to pay back $100,000 to the borrower, right? In this case, you would have a loss of $90,000. And you could continue that, right? If it moves to $2,000 a share, it would be exponentially higher. So if you invest for the long term, you only lose the money that you put in the first place. But here it can go exponentially high and you could get completely wiped out. That's what we consider a margin call, when your broker or bank calls you to either put in more money or they will liquidate your position, materialize the loss, and they will close your trade and you lose all that money and sometimes even more from other positions. So it's extremely, extremely risky. And not only that, you also have some other hidden costs in a way there if you want. The margin requirement, the borrowing fees. So there's also obviously the broker doesn't do it for free. They charge you a borrowing fee, or the bank, depending where you borrow it from. So that's something to consider as well. And that can really rack up over time. Obviously, the longer you borrow, the higher it will get. The interest charge as well. If you have a margin loan, if you take some leverage, there will be interest charges as well. The dividend payments. If it is a dividend paying stock that you borrow, then you have to pay the dividend to the rightful owner of the share as well. So that's something to consider. Plus, of course, transaction costs, often it's CFDs that you buy. So there will be higher spreads, higher transaction costs. So all those things should also be part of the total return calculation when you crunch your numbers. So yeah, while it sounds exciting to make money when the stock prices go down, it's really not that simple and straightforward. In my opinion, extremely risky because you can get completely wiped out. So short selling is really not investing. That's trading, it's speculating. While some people may make money, I'm not saying you can't make money. You obviously can make money. It's highly, highly risky. And I honestly would not recommend you to do so. Sounds fun, sounds exciting, but really I think the risks are way too high. You're better off finding companies you believe in, make money in the long term. People like Warren Buffett, right? They don't really do short selling. They are buy and hold investors for the long term. And I think that's probably the much better, less risky and less stressful way to invest your money long term. However, in case I still haven't convinced you and you're still willing to take the risk, well, then that's obviously trading at your own risk. And this is really not financial advice. I just want to show you how it's technically possible. Now, there are different platforms and brokers that allow you. Not all of them do. For example, eToro, you could very easily short sell a share over here. You just pull up whatever, let's say in this example, Tesla, you just pull it up over here, click on trade like you would buy it usually. But then, as you can see over here, instead of buying, you just press short over here. And here you basically start betting against the share price from going up. Instead, you will make money when it goes down. You say the amount, you can even leverage. But once again, the more leverage you put, the more risky it gets. Yes, potentially higher returns, but that gets extremely risky. See, now you put $10 and you have basically, you buy worth of $50. So you have a 5x lever on that trade. But you see, of course, there's also estimated opening costs and so forth. It's now a CFD. It's not the actual asset that you buy. And obviously, if you're fine with this, you deposit your money, click on confirm, and the trade is done. So that's really trading at your own risk. And generally, I could not recommend you doing that. And even if you do want to take some riskier position, maybe trade like day trade or swing trade, again, you might still lose money doing that, but at least it's your own money, right? Not more and not infinite amount. So yeah, I'm not really a fan of short selling. Now, it is obviously allowed. It's legal. There's nothing wrong with that if you want to do it, but just understand the risk and understand the concept in principle. But it doesn't always mean that you have to follow the same. If you still have any questions about any of it, let me know in the comments down below. Happy to hear from you. Next up, check out this video over here. As always, thanks a lot for watching. Stay healthy, get wealthy, and I'll see you in the next one. Ciao.